Good morning, ladies and gentlemen, and welcome to the show. Listen, I'm glad to have you guys here on this Thursday, the 4th of March, 2021. Thank you for tuning in. Now, we're going to get right in there today, and we're going to open up the charts right here and take a look. First thing I want to talk about today, the supplementary leverage ratio. It's called the SLR. And let's see. Let's go over it right here and try to take a quick look at what it is. It's Tier 1 capital, defined by Basel II. You know, these are things that banks hold, like treasuries and bonds and everything like that. It says U.S. banking organizations have long been subject to leverage capital requirements based on the ratio of banking organizations' Tier 1's capital to its average total consolidation on balance sheet assets. This is the United States leverage ratio. SLR is different as it takes into account both on-balance sheet and certain off-balance sheet assets and exposures. SLR was introduced by the Basel Committee in 2010, and it was finalized in January 2014. Basel II reforms were aimed at banks and how they hold their exposure to derivatives. A minimum supplementary leverage ratio of 3% applies to certain banking organizations and their depository institution subsidiaries. Okay, so basically what's going on here is they made changes to this SLR for the COVID thing, right? It says temporary changes. April 1st, 2020, the Federal Reserve Board announced temporary changes to its supplementary leverage ratio rule to ease strains on the Treasury market resulting from the coronavirus and to increase banking organizations' ability to provide credit to household and businesses. Well, the end of this month, March 31st, the end of this month, right here, it says that these rules will be in effect. It says these rules on the SLR will be in effect until March 31st, 2021. And then it's going to be up to the Federal Reserve whether they want to extend this policy change or not. The result, if they don't extend this policy change, and there's several senators, I guess Democratic senators that don't want to don't want them to keep this policy in place. Where did it say here? Let me see if I can find it. It says 2 prominent Democratic senators urged the Fed in a February 26 letter to let the SLR break expire on March 31st. And the Fed just might. But what would be the result of that? The result would be that the banks are going to pare their balance sheets down. And this could have a tremendous negative effect upon markets. Because the banks, you know, they're the holders of the who's got the most dough is not you guys and your Robinhood accounts and stuff. It's these banks. If they pare their assets the first day of April, well, you know, it could get really nasty out there. And so an awful lot depends upon this SLR. You know, this what's the acronym stand for? The supplementary leverage ratio. This SLR. An awful lot depends upon it. Gonna have to wait and see what the Fed does on the 31st of this month. But I'm thinking to myself, this could cause some sort of a turmoil in the markets come the 1st, depending on what the Fed does with this. If they extend it, well, then the punch bowl is still going to be out there, you know. So this is important. This is important, guys, and the date is March 31st when we're going to find out. Let's get in there and take a look at the silver price today. Silver price is $25.93. It's down 14 cents on the day so far. But it's not below its range. You see these 3 days, you see the red line is the blue line, I think, is 2 days ago, red line's yesterday, and the green line is today. You can see it's established this little range for itself in here between say 25.60 and say 26 or just right up close to 27, about 26.90 or whatever. It's established this range. It's on the lower side of the range right now, but it's not, hasn't broke through that range, you know. Let's take a look at gold while we're here. Whoop, I got the wrong one. Live charts, gold. Gold's up $5.70 at 1716.40 today. Cryptocurrency, 1526 billion with a Bitcoin price of 49,692. You know, it did break above the $50,000 mark yesterday for a little while. I think it went up to like 50,000. Well, right now it's 50,398. It just broke through 50,000 again. 50,500. Boy, it can go up quick. Oh, back down to 49,800. Oh my goodness, it's amazing how quick Bitcoin can move. You know, it changed price by what, $600 there for a few seconds. Went back down again. Okay. Dow Jones, we're looking at it's not moving much. It's down 6 points, which is almost nothing today. Now, listen, over there in China right now, their market is dropping. I guess by the worst it's dropped since 2016. The Chinese are having a little bit of a market turmoil there, and it's having an effect. It's having a negative effect upon our markets over here. Crude oil today, 62.35, and crude oil is up $1.07. That's a big jump, 1.75% today alone, you know. So crude oil's going up really good today. Let's take a look at the MOVE index. The MOVE index is up 8 points, or 14%, 65.83. But you know, let me see. It should be here in the 5-day. We can see that the MOVE index was up higher than it is now. It fell down, and now it's making its way back up again. It was over 75. It was up to 75.66 a few days ago. Why we watch the MOVE index? It's the credit markets. And I've stated before that the point of instability starts at 75. It doesn't really get unstable until the MOVE index gets up like 150. That's when things are going nuts, you know, in the credit markets. But 75 is where it starts to become unstable. Made it up to 75, that marker. It went back down again to 57. Now today it's back up to 65. So that's what it's doing. Bonds and rates today. Looking at a mixed bag, you know. The middle of the yield curve and the short end is falling, and the long end is rising, but it's only marginal today. It's not real big. 1.47 on the U.S. 10-year, and 2.25 on the U.S. 30-year today on the bond market. Dollar index today. We're looking at 91.14, and the dollar's taking a little bounce, you know. You know, I think I'll talk to you guys a little bit about my expectations for hyperinflation. You know, when exactly I'm expecting it to kind of start. We've been going through, ever since 2008, we've been going through a fine line. The economy is, I got to hand it to the Fed. I don't know whether it's their planning or what, whether they plan to keep it this way or what. But there's a fine line between deflation and inflation. And ever since the crisis of 2008, the Feds had total control. I mean, they took control when they started that monetary policy called quantitative easing. Okay, they took control of the system. And they've been integrating themselves in and controlling every market more and more so ever since 2008. And they have total control over these markets, and they've been walking a fine line between inflation and deflation. The problem with that is as they advance forward in time, there gets more and more pressure of leverage ratios within the system, and leverage within the system. And the leverage is created by the debt. And as the debt expands, in order to keep them walking this fine line, they have to keep injecting ever-increasing amounts of liquidity into the system. And, through monetary policy, most of that liquidity goes into liquidity traps, what's called liquidity traps, but it creates more debt. And as they create more debt, they also create more credit. Credit is the opposite side of debt. It's like a coin. You got one side's heads and the other side's tails. They've been walking this fine line, but as they're walking this fine line toward the future, more and more pressure's building. Liquidity pressure that's like stored energy in the system. And as they progress forward, they're going to reach a point where it's going to be uncontrollable. It wants to snap one way or the other, inflation or deflation. In order to keep it on that inflation side, or even to keep it on that line that they're walking between inflation or deflation, they have to keep pumping more and more liquidity into the system, into these liquidity traps through monetary policy, and then through fiscal stimulus, which is direct monetization of the system. That's the real inflationary one. You see, monetary policy is by its nature not very inflationary. And that's what we had since 2008 up until they didn't really start the fiscal stimulus, until that first stimulus package that they had when they sent out the $600 checks, back in March of last year. That's when they started their fiscal stimulus. Really getting underway, but they had monetary policy. And monetary policy itself, by its very nature, is not very inflationary. The money is mostly trapped in the system, in the Fed, and it's like a shuffle of bonds, within the system, and the dealer banks, hold these assets, but they're not allowed to sell them because it's like an account with the Fed, and it goes on the Fed's balance sheet, and it's almost like the money doesn't really exist. It exists, but it's like held at these accounts with the Fed, with these major banks, it's like an accounting trick. Is basically kind of what it's like, It's not really inflationary, but the fiscal stimulus is very inflationary. But at the same time, you have to understand, when they did that fiscal stimulus back in March, the system was contracting so bad from COVID, from them shutdowns. The system was contracting so bad that if it sucked up all that fiscal stimulus and more within the system, and it increased the money supply, but it didn't cure the deflation that's out there. And there is deflation out there. When you see all these businesses going under, you drive down, you see your local shopping mall going broke, and they're boarding up their windows, and that's deflation. The system's deflating. So the fiscal stimulus they're doing is actually not keeping up with the rate of deflation in the actual real economy. It's hyperinflating the stock market. So it's doing it. The stock market right now is already hyperinflating. The dollar's not hyperinflating, but the stock market is. We got a strange situation going on here, a strange brew, and the pressures that are building within it is going to be relieved at a certain point if the economy starts to pick up. And gee, what could make the economy pick up? Well, COVID saying bye-bye. Well, what are we seeing happening in the charts right now? We're seeing the COVID cases dropping really quick. I mean, going back to the start of this year, just a couple months ago, we were having, hundreds of thousands of cases a day. Now it's dropped back to was it 40,000, 50,000. It's way less. It's like a quarter of the amount of cases that we were having back in January. You know, it's disappearing fast. And the shots are going out. Well, you know, COVID lifts. You're going to see, if it starts to go away, you know, you're going to see people start to come out, you know, and start to socialize more again and start to want to go shopping. I haven't been shopping in ages. You know, Martha, I want to go shopping. Yeah, sure, let's go shopping. COVID's disappearing now, you know, take our masks with us. Yeah. And we're going to go shopping. They go down, and they'd start driving down the boulevard of their local town, you know. Oh, the mall's closed. Oh, I wanted to go shopping at the mall. Well, there used to be a bunch of stores over in that other side of town over there. Well, let's go over there. I drive over there, you know, in the car. Martha, they're all closed too. Nothing's open. Where are we going to go shopping? Finally, they find one store that's open, you know? Well, everybody's in there. They're all in there shopping because all the other stores have gone under. So, you know, I mean, massive business. They're buying everything on the shelves. Because, you know, I'm going to tell you, there's something tactile about shopping. Something very tactile about it when you actually pick something up before you buy it. And sure, we've been suffering through this whole thing with Amazon. You know, I mean, we've been shopping online. We've been doing it because of COVID. So, you know, you guys are invested in Amazon. When we see this COVID lift, one thing I'm going to tell you right now, Amazon has had a boon on this. It's been wonderful for Amazon. All kinds of new customers and everything else. Right? But when COVID lifts off and pulls away, a lot of people are going to say, hey, you know, I want to do shopping the way I used to shop. I need a new pair of shoes. I'm not going to do it online. COVID's disappearing. I'm going to get out there and I'm going to go to the mall or wherever. And they go and it's closed, you know. Well, you know, this is going to, people are going to want to open new stores. They're going to, stores out for lease. You know, the old owner, he couldn't make it through COVID. He didn't have enough money. He went under, right? But the building's still there. There's a lease sign on the front door, and he'll go to his bank, and he's going to try to get a loan, and he's going to try to open up that store. You would be surprised how quick all that can happen, and you'd be surprised, excuse me, you would be surprised how quick that store can open up again. They'll bring in a crew. A week later, it'll be back open. New owner, new sign on the door, new everything else, and a new bank loan. New inventory. Be surprised, and then he'll need help. So, oh, I gotta hire somebody, you know? This can happen so fast. It can happen overnight. The economy can start to heat up again. But what about all that money that they've stored in the system through all these big fiscal stimulus packages? Well, that money will really start to work. It'll start to multiply. Once they create it, the banks can multiply it. Then there'll be the new story opened up. He's got to get new inventory. He has to pay more because there's a shortage of inventory of everything right now, you know. So merchandise and everything, there's going to be a markup on everything coming from China and stuff. There'll be a markup because the container ships are half empty and everything else, and they're short on inventory and everything else. All these stores opening up in the United States for the consumer comes alive again after being dormant for, what, over a year with COVID? More than a year dormant, the consumer. Consumer comes alive again. You'll see sales for Amazon decrease. Amazon stock might start to go down. And you're going to see all these new stores and stuff opening back up. You're going to be amazed how quick it can happen. Especially in the springtime, you know. That's when people want to get out there and a man wants to go out and maybe he sees a business opportunity. And it can happen in a month. A month later, he can be reopening that store that was closed. So the economy starts heating up. all that money that they create will start to flow again, and you're going to see inflation start this summer. This is what I've been anticipating. And I talked about it as an economic recovery, sort of. It's not going to be super. It's not going to be like wild roses and everything, and boom, we're back back into a full economic recovery again. It's not going to be like that, but it's going to be better than what we have been going through. Like, it's going to be, you know, the country's been sick. The world's been sick. And, after you get sick, you slow starting to come around again. If you've had the flu, you start to go out, and you don't go out and do a marathon. You might want to go and have a meal someplace or something, something small, to get yourself back on your feet again. Well, that's the way with the country. The country's been sick, and the recovery's going to be kind of slow and tepid at first, but then it's going to start to heat up, I think, as we progress toward the end of this year. And I think by Christmas, things are going to be rolling along pretty good again. That's going to start the inflation monster. And once the inflation monster gets out of the cage, everybody can see it, then it's awful hard to stop it, because this whole big monetary thing that they've got with the dollar and everything is a confidence game. And once all these people out there see, okay, the stock market's not going to fall by 90%, we're not going to go into this terrible big deflation, they're going to take all those dollars that they saved, and they're going to start buying things too. This fuels it even harder, and so the confidence starts to be eroded and lost. Everybody can see it's inflation, that's the way it's going to go, and ultimately what happens, that feeds it. It's a self-perpetuating cycle of loss of confidence in the dollar and the purchasing power of the dollar. So people start to spend the money as soon as they get it. This is called, the definition of this is a crack-up boom, and so I see it really getting going, really getting hot, the inflation, sometime in 2022, probably past the second quarter, and then it's just going to keep going from there, because they can't raise interest rates to cool it down. That mechanism's broken, the Fed. It'll get out of control in 2023, and it's going to cause enormous problems within the system. Thank you guys for listening. Like and subscribe. We'll catch you guys in the next show, and you guys have a great day. Bye-bye.